Welcome back, everybody, to another episode from the Whip Report. In this lesson, we're going to cover the importance of recording job costs. And what does that mean? The importance, of course, you got to record job costs. What I mean in particular is when it comes to year end or period end, and it's time to close the month or the year, you want to make sure all of the costs you incurred on a project through that period or year end date are recorded, because it can really skew your financial statements. So if you have subcontractor costs or material costs or labor costs that you didn't record in the correct period, that's going to throw off your numbers. What better way to demonstrate this point than with an example? So scenario 1, 1231. You can say it's 2022, contract price $100,000, estimated total costs of $50,000. Cost to date through the year end on this project is $10,000. Bill to date through that year end is $75,000. Now let's take this same contract or same project and change some of the facts, or just one fact, I should say. Same contract price, same total estimated cost. Cost to date $35,000. Turns out there was a $25,000 material invoice that was not recorded in scenario 1. Bill to date $75,000, same as scenario 1, no change there. Let's jump into a WIP schedule to see what this really means. We got scenario 1 on this line here. This is a WIP schedule. It's hard copied, but the math is right. Got a $100,000 contract, $50,000 in total estimated cost. There's our $50,000 profit with 50% gross profit. Cost to date $10,000. Bill to date $75,000. Look at this number here, $55,000 in overbillings. That's huge. $55,000. So we're overbilled by that amount. Now, since it's an overbilling, we take our bill to date amount, reduce it by the overbilled amount to arrive at our revenue for the year. So that's the $75,000 minus the $55,000 leaves us $20,000 in revenue we can recognize based off the percentage of completion. So even though we billed $75,000 to the project owner or the GC, we can only recognize $20,000 of it. That's a huge adjustment. Now let's move on to scenario 2. Same fact pattern here in terms of contract price, estimated cost, gross profit, and percentage. Here we see that $25,000 invoice incorporated. So instead of $10,000, we have $35,000 in costs to date. Billing $75,000. Look at this huge difference. $5,000 in overbillings. We went from $55,000 to $5,000 in overbillings. That's a huge difference there. You take your bill to date amount minus this overbilled amount, and you're at $70,000 in revenue you can recognize. So clearly, huge difference in how much revenue you can recognize. Now, what does this mean in accounting terms? Well, the first scenario, we have our standard over-under billing adjustment. We decrease revenue, which is a debit here, this positive number, and we increase overbillings. There's the offsetting credit for $55,000. This just summarizes what I was just saying here with the billings of $75,000 minus the overbillings leaves us with $20,000 in revenue minus our costs. It's $10,000 in gross profit for the whole year, assuming this is just your only job. So let's do the same for scenario 2, except we have this additional entry here to accrue job costs. Accrue, you can call it to record an additional job cost. You got your cost increasing by $25,000 and your accounts payable increasing by $25,000. Now you can record your over-under billings. Instead of reducing it by 55,000 as we did up here, we're only reducing it by 5,000. And there's our 5,000 increase in overbillings. Take your total billings to date minus your overbillings, that's 70,000 in revenues earned, minus your costs. There you go, $35,000 as opposed to $10,000. Huge difference just off of recording that one invoice. That changes everything that really matters on your financial statements. Your overbillings just dropped significantly. Yes, you added another liability, but for $25,000. But your income went up $25,000. Your overbillings decreased by $50,000. This is going to look more appealing to your bond agent, your surety, something to keep in mind. So one other important thing to point out is, yes, overbillings are a liability just as accounts payable is a liability here. The amounts are significantly different. In this scenario, you have accounts payable and you have overbillings for total increase in liabilities of $30,000. That's $25,000 different, but it's telling a completely different story. Just look at some of these markers here. $40,000 in cost to complete. People are expecting you to incur $40,000 more in costs to finish this project. You've only completed 20%, yet you've billed 75% of the contract amount. Seems strange. This comparison between billed to date and overbillings just seems off. So you can tell there's something going on. Either the estimates are incorrect and it needs to be adjusted, or there's some costs that haven't been recorded. You go to scenario 2, it's a little more believable, right? Because there's $15,000 in cost to complete. So, to say you've billed 75% of the job with, $15,000 left seems reasonable. You've completed 70% of the project. And this overbilling doesn't look as goofy in comparison to your bill to date. So just from the aesthetic standpoint of looking at it to see if it looks right or looks goofy, scenario 2 looks better. And it makes more sense. So you can see how important it is to record job costs and not let things fall off to a different period, because it changes the numbers significantly. And it makes for a better WIP schedule. It's more believable. And the more believable a schedule, the less questions you'll get and the quicker you can get your bonding. So that's the important thing to keep in mind, is cleaner, more accurate information, more timely, less questions, so you can move on with your day. Thanks again for tuning in. I'll see you in the next lesson.